Good morning. Happy December. Welcome to Wayne's World. My name is Wayne, and for the next hour or so, we're going to be in Wayne's World looking at, once again, end of the year tax deductions. But before we do, a couple of things. Many of you have heard me month after month, week after week, live, here, on Zoom. One of my passions is for agents to buy at least 2 income properties a year every year they are a realtor. Still got time. I'm happy to say that I just made an offer on December 2nd, that was accepted on December 3rd. Started paperwork on December 4th, so I did buy an investment property. And I believe you should be doing the same thing. There's still time. There's still money. There's still owner financing. There's still contract sales. There's still purchase money mortgages. There's all kinds of avenues, so you have no excuse. See, it's easy to make excuses than to make goals. And so there is an opportunity to still be able to buy an income property before the end of the year. And we'll talk about that in more detail. But most importantly, I wanted to sit back and reflect on some things we talked about, but then add a new topic. And it's kind of a nice name for it. It's the PATH Act. And as you looked at my advertisements on Facebook asking you to join me, maybe you already know about the PATH Act. But many, many people do not know about the PATH Act, yet it's nearly 7 years old. Once again, I remind a lot of my friends, a lot of my colleagues, and just remind myself every so often, there's things I got to make sure I'm doing to take advantage of the tax laws as they benefit me as a realtor, as an investor. With that said, let's kind of move forward and talk about some things that will be reminders for some of you, aha moments for others, and maybe even overwhelming that you'll need to do some more work after we're done. Because I believe you don't just sit and listen for an hour and take this Facebook Live program each week. I believe this takes you into going to websites, to talking to people, to setting up a plan to be able to reap the benefits that are available to us as real estate professionals. There are very few occupations and very few investments that can match all that we have in front of us. It's kind of like we're sitting on acres of diamonds. If you read that book years ago, you should. It's right in front of us, and we don't take advantage of it. With that said, we're going to be reviewing some things we did back in October on some tax tips and add some new ones, just to remind you that it's still time to make some end-of-the-year changes in the process. I shared this website a few weeks ago. There's loads of these out there. There's one that's 115 tax deductions. There's one that's 150. There's one that's 10. They all cover some of the same areas. Just basically Google real estate agent tax deductions. You'll find a myriad of things. Google real estate investment tax benefits. You'll find numerous sites and places to go to, many of which I use to bring some of the material I'm sharing with you today. So this, again, is almost like our hour today is nothing. There's homework. And I remember in college, they told us for every hour of class, you should study 3 hours at home. Well, maybe that's not bad advice if you're serious about being a real estate investor and a real estate professional who reaches their ultimate financial goal and push past their self-imposed barriers. Because most of us, including me for a while, had my own self-imposed barriers. I could have not made a real estate purchase in December. I could have ended the end of the year and said, next year. But what did I do? I did it. I walked my talk. So if I can do it at the end of the year, you can do it at the end of the year. Please don't hesitate to leave this session today and go right into your MLS and look for some properties that meet your criteria. Capitalization rate for me has always been the best indicator of what I can do with a real estate investment. So as we look forward to some topics today that'll be new, again, I want to remind you, I am not an accountant. I am not an attorney. I am basically not providing any kind of tax advice. I have used people around me and surrounded myself in my board of directors, as I call it, who can give me information I can share with you. But you have to realize you need to verify that. Maybe it's the trust but verify theory with your own tax person, your own legal person, and your own accountant. Makes a lot of sense. Just good due diligence. We should be doing that in every transaction we have. So reviewing quickly, commissions paid. It's obviously referral fees, etc., which are legal in your state, need to be taken care of. We talked about the home office. We'll do it again. The key thing here is to realize if you have an office at work and you have an office at home, there are some issues with trying to take deductions from both of those. Again, most of us are getting further and further away from using an office for any special reason like we did before. Offices are changing the way they're being built. We're seeing mega offices evolving that are building new offices to hold 400 or 500 agents, but never all of them there at one time. But the bottom line is you will be able to reap some benefits of Form 8829 deducting for your home office and all the expenses, in addition to the vehicles, which we'll talk about with the path. Third thing we alluded to was desk fees, because as I said, you can't take both. So be very careful. Fourth thing to realize is education is from womb to tomb in this business. I spend a lot of my time doing wealth building seminars, continuing ed classes, negotiation designations, and just common sense sales courses. Everything you do once you have the basic license from now until forever is 100% tax deductible with your record keeping being in place. Everything. But the only thing you have to be careful of in training are some laws that might be state imposed regarding things. Or again, if you're here from a different country, for example, I'm going to be doing a CE cruise in January of 2024. We'll take probably 7 days, probably in the Caribbean, to get some Illinois CE credit for people who would like to, plus a negotiation designation. But that said, if I was in Canada, I could not teach the classes on the cruise ship. Canadian law says you must be on land, so I could take a cruise, but we'd have to get off the ship and go to some real estate office or some training facility in one of the cities or provinces of Canada to be able to get a taxable deduction for those people that are Canadian residents. But for all practical purposes, registration, related materials, books, travel costs, all the kinds of things you do, even entertaining some clients at some of these meetings or meeting with other agents, as long as you're not qualified for a different trade or business. So that does mean if you start out with a salesperson license in your state that is salesperson and broker, or a broker license where it's a broker managing broker, upgrading to the next level of license in your state is not considered a different trade. But taking classes to be a home inspector, as well as a real estate agent or a mortgage loan officer, those classes would not count. Once you get that license, then if you took additional home inspection classes, took additional mortgage loan classes, all your expenses would be deducted for all those aspects. Many of you have just returned from the NER convention in Orlando. You know all the costs. And I'll remind you several times, but I want to get it out of the way right now. Training is critical. Coaching is critical. Mentoring is critical. You need to have someone who you can align with who will help you grow that business. Just as professional athletes all have specialized coaches, so you as a real estate agent should have specialized coaches. Now, all your advertising, all your marketing, your billboards, your signage, your cards, you name it. If you printed it, shared it, put it on the internet, anything, Craigslist, Facebook, Instagram, all those things, the cost of styling or staging a property, are all deductible. It's such a broad area when you say marketing materials. And that's why I learned quite a bit from one of my favorite sponsors of my seminars, Cutco Knives. Cutco Knives allows you to give gifts that are called marketing materials for tax purposes to avoid the $25 gift maximum from the IRS. Many agents have been, unfortunately, taking illegal deductions or, quote, evading taxes by writing off the whole cost of a closing gift that did not meet the criteria of being a marketing material. I would suggest you strongly look at products, things, services that meet the criteria of marketing materials, because it is broad in the IRS guidelines to be able to take a maximum deduction for the total cost of whatever it is you're providing in marketing to your client base. It's a big one. A lot of people don't have a reason to think they'll be audited, or if they do, they say, I didn't know that. Well, at the IRS, ignorance is bliss, but it's no excuse. We'll talk more about autos and the news deductions, all your office supplies, all your equipment. We'll talk about the 179 tax deduction here and the PATH Act in a few moments. But again, you buy a lot of things, even simply the tape you use to put a sign up in a window, or something for an open house or an easel or whatever it is. Anything you do, if you go to Kinko's or FedEx or some other places to get things done, all your furniture, all your electronics, and the bills associated with those, all those specialized cable channels you use for various reasons, the shows you tape on real estate that you'd like to use later and watch to help you become better at what you do, whether it's rehabbing, flipping, or just learning how to sell. We're seeing a lot of changes. Now, this is the biggie. I mentioned this before. Many of you already have done an appeal of your 2021 taxes, but last year and this year, all your business-related meals are now available at 100% deductibility due to a COVID-19 relief policy. So this year, everything you spend in a legitimate business deduction of meal with clients, colleagues, yourself, if you're doing the research and reading while you're eating, those meals are 100% tax deductible. And if you didn't do that last year, as I suggested a few weeks ago, you file a 1040X. If it looks like it's profitable, check with your accountant or look at yourself if you do your own taxes. But this is a very unique benefit that ends this year. This is the last tax year that I doubt they'll extend it. I mean, they could. Then you've got all the things you do in memberships. Please remember, though, our PAC dues, although I advocate those tremendously, are not considered tax-deductible expenses. So make sure your accountant is aware of that, because oftentimes it shows up as part of a bill at a board, and they may not know that that has to be pulled out. Our PAC deductions are not tax-deductible by IRS rules. But again, consult your accountant. Consult some legal advice. NAR has several nice articles and videos that explain that to you. Once again, though, I would encourage you to be among those that become major investors to support our PAC, to allow us to continue the work we do and help private property rights. But once again, be very careful with the tax deductibility of things. Number 10. A lot of you have spent a lot of money on CRM, search engine optimization, any other business tools. Some of you have a lot of things you post on Facebook. You've got a lot of videos and little animated things you do on TikTok, and now you're doing Reels. Those things are all deductible. And if you have people doing those for you, their expenses are tax deductible. Just be careful you understand how to treat those people doing work for you, either with a 1099 or they're in a company that you employ and pay a fee to. Again, be very careful. Many agents will get unlicensed and or licensed personal assistants, and sometimes their tax ramifications of whether they're an employee or an independent contractor or an outside company get questioned in a tax audit. Also reviewing the $25 fee. Again, if you work everything you do into marketing materials, you will be able to bypass the $25 limit legally and avoid not getting all the benefits for a larger closing gift that's considered a gift versus a marketing process you use that's more than $25. And the last one is health insurance. And here's where it opens up a whole new, I guess, arena. Because health insurance is always an issue. Many of you are fortunate to have a partner or some family member whose insurance you are on, and that changes the game plan. But if you're paying your own health insurance and you also want to bring your family into that plan, now we're starting to look at some additional tax benefits. I honestly feel many agents have not taken advantages of the tax laws as they relate to hiring your family members as part of your real estate venture, your business. That means you get into the proper legal form of ownership, i.e. an LLC or a corporation, subchapter S or full C, depending on your accountant's advice and your attorney's advice. But now you bring your family on as employees. Your mother-in-law, father-in-law, sister, brother, children, all kinds of people could become employees. And now you could provide health insurance. You could provide annual meetings, quarterly meetings. You could do a lot to move your health insurance costs from your Schedule A in your taxes to your company, corporation, or whatever form of ownership you have. I would suggest strongly you look at not just publication 535, but some other publications and tax advice on making your real estate business a, quote, family business, paying your children a salary to bring them up to a threshold where they pay no federal income taxes, but you're writing off those thousands of dollars against your income. See, the goal, the passion, this presentation is built along a simple concept. It's legal to avoid taxes. We are almost mandated by the IRS to pay the least amount of taxes. And so in Wayne's world, I've always had the mindset that I will never know if I pay the least amount of taxes until I've been audited. Sometimes the IRS finds deductions I missed. Sometimes an accountant didn't tell me to take that deduction, but I took it and the IRS said, that's fine, you can do that. So again, I don't fear an audit because I avoid taxes. I report everything I'm supposed to report. I take every deduction I'm supposed to take. I follow the guidelines as best I can have them interpreted by my legal people, by my accounting people, and by my personal feeling as I read the law. But everybody's different. But we have enough publications, enough information. I'm sharing a few of them today. But it's totally up to you to decide how you want to handle all these major little simple deductions. Now, moving forward, those were 12. And many sites talk about all of those. And again, as we said, the key to your success is some kind of a basic system. I'll give you some examples of some of the programs that are available for purchase. I love TurboTax for people. I love QuickBooks for people. I love Excel spreadsheets if I want to do my own things. A lot of options available. The key is to find a basic, solid filing system, taking pictures of your receipts and storing them in a file, using a separate credit card for only your business purposes. I actually even took a deduction years ago, which I was challenged on, but won because I'd bought two briefcases, two Hartman briefcases. I remember this so vividly because the IRS auditor was very upset that, first of all, I had a briefcase worth $750 and I had two of them. One in beige, one in black. Why? Because I got buyers and I got sellers. I do not want to be a person that's moving stuff from one bag to another bag to another bag, back to another bag, or leave something out or forget something. So if I'm going on a buyer counseling session, there's the tan one. Going on a seller counseling session, there's the black one. It's pretty simple. Worked for me. Bottom line is, IRS said, yep, I guess you're right. And because I bought those at the end of the year, I used my Section 179 tax deduction and wrote those off in their entirety. And this is why this month is so important. You really have 3 weeks roughly to take a look at your potential tax liability for this year that you'll report next year by April 15th, and see if I could find a way to make some large purchases, some very large purchases that I could write off totally against my income to avoid taxes. With that said, I mentioned the PATH Act. And this is a nice little act that started in 2015. Yet for many of you, this is the first you're hearing of it. Why? I don't know. Seems to me your accountant, now maybe he didn't call or she didn't call it the PATH Act, but were they using the provisions to immediately deduct all or a greater portion of your purchase, which means bigger savings at tax prices? And there's my best example, because vehicles are a large part of our life. I drive vehicles I would not drive if I weren't reaping the tax benefits of being a real estate professional and be able to write them off. Look at this. This year, and there's still time to buy one, you can write off up to $27,000 of the price of a new car. If you can write off $27,000 against your income of $27,000, and you're in the 33% tax bracket, you just saved $9,000 in taxes to the IRS by avoiding taxes, by instead of having to report a $27,000 profit from your real estate investment business or from your sales business, by offsetting with a $27,000 deduction on the price of a new car. Now, once again, there are several publications from the IRS that tell you what to do and how to do, but the PATH Act was a way that was put together back in 2015 to protect Americans from tax hikes, PATH. What a nice word, because it takes you down the path of tax avoidance strategies. It's a path that if you use it, it's a great way to get to your end goal, avoiding taxes legally. Now, there are limits, there are criteria, there are all kinds of things to do, but the bottom line is those are real numbers, people. Those are real numbers. So do not hesitate. You got a few times left. Take advantage of every deduction you can. Again, I probably repeat myself because I love the tell them theory in my training. Tell them what you're going to tell them, and tell them you told them. Man, it should sink in. Once again, these are the most common real estate agent and broker deductions. We talked about marketing, but don't forget the coaching, the training. Some of you pay for a webinar. Some of you have a membership in a trainer's online services or other ways of reaching education. Some of you belong to a network where you pay so much in fees to access certain things. Some of you are using some of the websites, even some TV shows that you pay per view on that are real estate related that could be tax deductible. Your association dues, MLS services, just be careful in how you handle your RPAC major investor dues. And if you're not a major investor, make a commitment. We need that support. That's another whole topic, but I'm passionate about buying 2 properties a year, being an RPAC major investor, and operating in a legal, ethical, and honest way in this business, as well as avoiding taxes. Again, sometimes you take public transportation. Many of you were at the NAR convention, taking an Uber, taking a Lyft, maybe getting on public transportation to go from one place to another, the cost of going to and from the airport, the tips you gave the person that handled your baggage or got you out to a rental car, whatever it might be. A lot of expenses. Again, in-flight meals. If you're traveling and want to buy something online, you can register your credit card. It's on there. You charge it automatically because it's contactless purchase on most airlines. I just flew back in last night, and I was able to have a meal. And if I needed to spend any money, it's contactless purchases. And again, if you're a renter, now why you're a renter and sell real estate, I don't know. That's another whole seminar. But if you are a renter, don't forget, portion of your rent could be used if you use an office in your home. And keep in mind, the bottom line is what you're doing ordinary and necessary? Wow, that's pretty basic. I can justify everything I do in real estate as necessary because it helps me grow my business. It's directly related to my business, and it's a reasonable amount. It's a reasonable amount. And again, 2 publications, 463 and 535, give you a whole list specifically of what is and what is not reasonable in the eye of the IRS. So once again, as you review this, this is on my Facebook site to listen to again. Please remember, there is so much that I don't cover or can't cover or really feel you need to cover on your own with your appropriate advisors. And say, hey, I just heard about this PATH Act. Am I taking advantage of it? Did you do that for me the last couple of years? I mean, 2015 is when it started. Now, you only can go back 3 years and amend your returns, but it could be important for some of you. I don't know what or how you do your taxes. All I do know is many people pay more than they need to legally. A couple of other issues. Capital gains taxes. This is an interesting one, and it's open to a lot of interpretation. But I, as a real estate investor, oftentimes, and I have many friends that have done this, will buy a property, use it as a rental, then move in for 2 years, it becomes a personal residence. A lot of people flipping, as I see here and show you here, are doing that. So I buy the property, I flip it, but then I move in. And if I'm there for 2 years, it's considered a principal residence. And I take that huge tax deduction of selling my personal residence. Also realize your rental properties are not the income from them are not subject to Social Security or Medicare taxes. So more and more expenses you can pull out of your rental properties, and more of the things you use are going to be a tax benefit. Many months ago, I shared the first credit card I saw that's based on a HELOC. And now I can use that HELOC as a first mortgage. And there's a whole myriad of YouTube videos, a whole myriad of articles on using a HELOC instead of a first mortgage. It's not easy, bit complex, but anything that benefits you usually isn't easy. But record keeping and a system of working, and many of us, especially with the way we earn our money, big checks for a while, then nothing, then a big check, you might want to look at using the HELOC as your first mortgage. But if nothing else, start using more of your rental property income to pay your expenses. And because of no FICA taxes or no Social Security taxes, that's big chunk. 7.65% of your earned salary is gone. So cut out that process. Spend some time talking to an accountant on that one. Got to remember one thing about my whole mindset. You and I do 3 things with our money. We consume, we invest or save, depending on what you call it, we pay taxes. Now, obviously, we're talking tax avoidance strategies today. If I can avoid taxes, as I gave you the $27,000 example for the car, I've got more money to consume or invest. Then if I get better at my consumption pattern, how I spend my money, how I negotiate, wow. Maybe I can save 50, 100, 200 there. Those are tax-free dollars. Anytime I save money by negotiating a lower price for anything, that's tax-free money. I love tax-free. I would hope you love tax-free. So above all, take advantage of the capital gains rates. Take advantage of the ways in which you can buy a home, use it as an investment, then turn it into your personal residence. Many of my friends buy investment property and know where they're going to live for 2 years after a while. Many of them do that in a retirement climate. And then they use it as a personal residence for 2 or 5 years. And now they've done quite a bit to avoid taxes legally. Once again, you need the advice of an accountant, you need the advice of somebody who understands what I'm talking about. Or you just got to do some reading on your own in the process. Again, we're not going to cover this today, but the IRS has some new rules on qualified business income, which creates a safe harbor for rental real estate. And this is not a rental real estate section, but I want to remind you, it does tie in because you as an agent reap the benefits of the tax laws with unlimited passive losses against your income and some other benefits. So that's why I keep trying to tie in. I'm a realtor, I'm a real estate investor. I'm a realtor, I'm a real estate investor. The laws have allowed us to be able to avoid a limited passive loss of up to $25,000. We can go unlimited against all of our income. And please remember this. It's just a number you'll have to trust Wayne and believe me in Wayne's world. Every $1 million of building value you own, I don't care if it's one building, 10 buildings. I don't care if it's small condos. It doesn't make a difference. It could be a mansion, whatever it is. If it's considered investment property and you're filling out a Schedule E, rent and royalty income, you can deduct $36,000 of quote artificial expense, i.e. depreciation against your income. To make it simple, if you owned $1 million worth of building value and you wrote off all the expenses you can write off, all the maintenance costs, the insurance, if you have a mortgage loan, the interest, everything else, and you still showed $36,000 in profit after all the bills were paid, whether you got positive cash flow or not, you could then write off $36,000 to bring your tax liability down to zero. Or if you actually had a loss, you could write off the rest of that loss against your income from selling real estate. $2 million, $72,000. $3 million, $108,000 of your income could be written off because you're writing off this artificial expense called depreciation. It's part of the ideal investment seminar I do, and we have to repeat that soon. But there are some new rules for safe harbor real estate. So please, again, consult your accountant. The qualified business deduction is out there, the QBI. You can spend some time on that. This particular law firm has a lot of free material out there, but there's many ways. Just search QBI real estate deduction and you'll see a lot of articles on that process. Qualified business income. A lot of IRS rules on that. Probably can't do it yourself, but again, hire great brains, a good accountant. With that said, there's a lot to be said about all the things you can do potentially with Section 199, as it's called. So I've come up with, again, maybe a summary or a review or just a thought process, just basically 6 things to remember. And the first one is, and I said it earlier, keep it in the family. You know, I had the privilege of being on the faculty for True Value University, and they have a huge, huge university program to help their owners of their hardware stores across the world keep it in the family. They try to show family succession. And again, one of the biggest, I feel, loophole, if you want to call it that, you can use the family, as we said earlier, as employees. You can use losses claimed from your real estate business against your overall income. Even if it's from another industry, if you've got a partner or spouse that works, maybe you can offset his or her income. Who knows? Just because one of you is not in real estate doesn't mean you as a family can't take advantage of that. And as I said, find out what the limit is before your children have to pay taxes. How much can they earn in 2022 by doing things for you, filling out forms, dropping things off on doorknobs, you name it. You pay them, that's a legitimate expense against your business. They get tax-free money to use for college or for a career or for who knows what, a car, and you reduced your income. Keep it in the family. Second thing is to realize that D word. I mentioned it, the power of depreciation. It's an accounting method that spreads your asset costs over a period of time. Now, the Section 179 deduction is where you can write it off. The PATH Act allows you to write that whole $27,000 at one chunk against the total value of the car versus just taking so much every year equally. There's a lot of different methods of depreciation. There's different asset classes. Some are 3 years, some are 5 years, some are 7 years. So you need to remember there's some work to do on this, and maybe it's best to hire a great brain and pay the fee, which is tax deductible. Your accountant's fees are tax deductible. So depreciation is considered a paper loss. You don't have to spend any money to deduct it. It's a nice way of looking at things. I get a tax deduction and don't have to spend any money. We talked about avoiding capital gains taxes. Just one example is after you flip a place, move in for 2 years, fix it up, reap the benefits, and then use your rental income to avoid payroll taxes. Again, the income from rental properties is not subject to Social Security, Medicare taxes. You know, we're back to my simple process. I firmly feel from my heart, I really do, that as you each year become better at what you do in the real estate business, you also become better at a real estate investor mindset, and you continually increase your passive income. Now, it could be for some other things too. I mean, we talk about side hustles, multiple streams of income, a lot of ways of doing this. But the point is, if I can avoid taxes by using my rental properties and the expenses I need to spend from that account to pay for my medical, to pay for this, to pay for that, I'm avoiding what looks like not the best tax form anymore, Schedule A. I firmly believe, and some of you have heard this, that you win in wealth building with aces. Wealth builders in Wayne's World are holding 4 aces. It's a good hand. 4 aces is a good hand. And there's a wild card to make it even better. The wild card is tax avoidance strategies by using Schedule A, profit itemized deductions, Schedule C, profit or loss from business or profession, Schedule E, rent and royalty income, and Schedule S, self-employment. I look at people, and if they say they filled out those forms, I feel they're wealthy in whatever price point they are in income. They're a wealthy individual at that price range, whether they're making this, or this. You win with aces. And you can do that quite heavily with more rental income. And then another one that's going to pop up as we see what's happening is the key to refinance. Remember, you can save big on taxes by refinancing. You're going to see a lot of people next year look at refinancing. I'm sure many of your lenders have talked about it. Take advantage of capital gains rates, take advantage of refinancing, take advantage of using your rental income to avoid payroll taxes. Make sure you understand how depreciation works and the 179 deduction and the PATH Act, but above all, keep it in the family. There's so much to be said. Plus, when you have this, quote, family business, everybody gets excited. and everybody's a part of it. And you can do a lot with that. This is an interesting one too. See, we had something in 2015 called the PATH Act. In 2017, we had the Tax Credit Jobs Act, and we talked about that. The bottom line is, in 2022, you as a single taxpayer can benefit with this deduction if you're a single person making up to $170,000 or married $340,000. But here's the key. When we're talking about income with the IRS, it's adjusted gross income. It's income after you write things off. There's ways to reduce your income. For example, there's a place for educational expenses. I, as a real estate trainer, can write off $300 against expenses I need for training people like here today. That comes right off my regular income. It's not like an itemized deduction. That reduces my AGI. See, your goal is to get your adjusted gross income as low as possible before you put all the other stuff into it, i.e. your Schedule A, etc. How can I get my adjusted gross income? That's what we hear that the Jeff Bezoses do, and the Warren Buffetts do, and the Donald Trumps do. I mean, they avoid taxes by finding a way to get their adjustable gross income down. Then with all their expenses, they pay very little or no taxes legally. Now, once again, if you breach that legal aspect and start evading taxes because you get greedy or because you think you can do something and don't have solid advice, but we have the 2015 PATH Act for you to look at, 2017 Tax Credit Jobs Act, and some of the increases along those lines to make your tax avoidance strategies be as strong as possible. There's also some changes in tax breaks for small businesses. You might want to go take a look at some websites that just talk about small businesses, not just specifically real estate. But this is where the depreciation has changed and the maximum 179 tax deductions have changed. So I just alert you to the fact that we are considered a small business. So as a small business, we reap those benefits. And the caps get amazingly high. Spending caps on equipment, you probably wouldn't do this in your real estate business, but $2.5 million. There are a lot of reasons why businesses are needing less employees because they can buy more capital. Employees, I have this simple analogy. I like acronyms, CELL, capital, entrepreneur, land, and labor. Well, capital is the stuff, the equipment. Land is land, labor is people. What are we doing? We're eliminating people that are labor costs and buying capital equipment, self-checkouts, automatic this, push button that. Because as a business, I can keep buying new equipment, even in real estate. I can buy a new 8K TV today. I just saw one advertised yesterday, 8K. I've got 4K, and now they're selling 8K. And somebody's still using a 1080 HD. I got a 4K computer. I could buy an 8K laptop soon, I'm sure. We got OLED, QLED. We got all kinds of things to make our viewing pleasures much more visible. If you wanted to see the MLS in my home office, you would look at it on a 130-inch screen that's 4K. Now, it may not be transmitting 4K from the MLS, but it's going to make that picture brighter as 4K and much more clearer. But some shows are 4K. Now, that's another whole technology issue. I just know that you can have a lot of spending on capital equipment, which you write off immediately, and we've got all kinds of other advantages. So I would suggest strongly, again, we're back to reading, asking, and selecting a top accountant to do things for you along those lines. So in closing, The best number one tax loophole in Wayne's world, and this is one of Wayne's 10 commandments of wealth building, not suggestion, in commandments, is avoid taxes like poison, ATLP. Another one, which I guess is the second best tax loophole, is HGB, hire great brains. Find an accountant that does real estate taxes, so he or she knows. I learned so much over the years from an author in Missoula, Montana, Vern Hoven, Hoven. He still has some books out. I'm not sure how current they are, but he had some of the best advice for real estate agents and tax laws. Vern Hoven seminars. A genius. We have Chris Bird in Illinois, who does tremendous seminars and powerful information for realtors. Many of you may have seen him in a NAR convention or a state convention or somewhere else. But boy, the key as we leave here today is to remember the number one best tax loophole, and then realize that the secret to success in Wayne's world is to remember to use tax avoidance strategies versus tax evasion strategies. Report every penny, take every legal tax deduction, and you'll lower your tax liability. Now, if you stretch those rules, you may have a problem. Many years ago, when we had TV antennas as our only way to get a signal, some of you have no idea what I'm talking about, but go on and look at a TV antenna. We had the big tower, and on the top we had this antenna. Well, you could buy a rotor to move the antenna to get different stations in different places. I was watching some real estate shows in different cities by rotating my antenna, west, north, south. Living in Illinois, I'd go up to Milwaukee. There was a great real estate show in Milwaukee. There was one in Moline, Illinois, and there was one in Chicago. I needed that rotor. I needed that antenna. So I wrote off my rotor, my antenna, my tower, and all the wiring. IRS challenged me. I was audited. And once again, what's it say in Wayne's world? You will not know if you paid the least amount of taxes until you've been audited. So I welcomed the audit. Back and forth, back and forth. The final conclusion. Yes, the rotor is necessary. Yes, the wiring is necessary. Yes, the antenna with that motor is necessary, but we're not going to give you the tower and the base. So the majority of the cost was the antenna, the rotor, the wiring, but the tower was the least amount of expense. So I didn't get it all, but I got a lot. See, tax avoidance strategies allow you to read and interpret the law the way it was written. When you evade taxes by not reporting your income, by not reporting all the money that you earned by doing something in real estate, or you find illegitimate means to do things, you have a serious problem, and you won't know that until you've been audited. And again, the IRS is pretty simple. They basically say you have to prove you did it. You could make up a tax return every year. You could have total fabrication. And I'm sure there might be someone in this country that's making up numbers every year. They just put numbers together. Until you've been audited, nothing happens. Now, once you're audited, they're saying, okay, show us you did this. Show us you paid that. I have some issues with my tenants because I give rent concessions for people that maybe sweep the hallways or do some light maintenance. Well, I've got several options, one of which is not to just reduce their rent and have less income and hope they report it, because that would look good. I could knock off $3,000, $4,000, $5,000 by giving this person a rent credit. So now my income looks less because I didn't collect that much rent. And they probably didn't report it as income. So my very simple philosophy is you pay your full rent. I cut you a check for what I owe you. We write it off in a 1099. It's pretty simple. Or if they're a company, like I have one gentleman who's got his own carpet cleaning company, I just pay his company when he vacuums and cleans the carpets in my entryways. It's a very simple deduction. He has a carpet company. He lives in my building. I hire him. I pay him as I would pay any other company with my credit card. See, we've got a lot of ways of doing this. The key is right there at the top. Avoid taxes like poison. Never evade taxes for any reason. The temptation will bite you in the ankle, and in the long run, you will lose instead of save. So we have done quite a bit today. I do think the key thing to realize is, has the PATH Act become a part of your tax strategies? Are you using the 179 cap? Are you using the qualified business to your advantage? Are you using the concept of marketing versus gifting? Are you keeping track of all your expenses in a way that's easy? And you don't always need receipts. There's a little bit of a misnomer there. If you can prove you did it, and usually it's under $75, they're not going to get too much of an issue. It's when you get these big purchases you have no proof of. Some people give out home warranties as part of their marketing package. That's a deductible expense as part of your business. So I leave you with the ability to say you've got basically 26 more days to get a real estate property purchased and closed to take advantage of the tax laws this year, and look at the things we covered and realize that in Wayne's world, there's 10 income commandments. We've talked about a couple. With that said, enjoy your week. Get ready for whatever holiday you're celebrating. We have Kwanzaa coming. We have Hanukkah coming. We have Christmas coming. If you're smart, you'll at least support all three and enjoy the fun of the holidays. Have a good day, good week, and good luck on buying an income property before the end of the year.